Welcome to the GCV Weekly Briefing Podcast, where we break down key financial and economic developments shaping the outlook for investors, businesses, and policymakers. My name is Matthew, and this week we're looking at four major stories, from inflation easing and the Bank of England preparing a possible Christmas rate cut, to the unusual split between UK and foreign investors, and the shifting consumer behaviour here at home. As well as this, we're looking at the US jobs report ahead of the Federal Reserve's final meeting of the year. There's a lot to unpack here, so let's get started. Inflation slipped to 3.6% in October, down from September's 3.8%. The fall was expected, but the details are what matter here. Softer energy costs and cheaper hotel prices point to something more durable, and service inflation easing to 4.5% undershoots economists' forecasts. This gives the Bank of England some room it hasn't had in a while. The shift comes at a sensitive moment. Rachel Reeves is preparing a budget that is widely expected to raise taxes this week, and the broader backdrop looks soft. With the economy growing only by 0.1% in the third quarter and unemployment now at 5%, normally that mix would make the bank cautious. But hints from the Monetary Policy Committee suggest that December could be when the rates start to come down from 4%. Traders think so too. Markets are now pricing in an 85% chance of a quarter point cut next month. Gilt yields barely moved after the announcement, which tells us investors had already anticipated this reading. Core inflation also eased to 3.4%, although food and drinks inflation has ticked up slightly again. The direction of travel still remains steady. Andrew Bailey has spent months managing disagreements within the MPC, with growth slowing and inflation staying stubborn. But this set of figures breaks that pattern. One economist summed it up pretty neatly. Sanjan Raja from Deutsche Bank said that the figures provide a clear path for a Christmas rate cut, adding that Andrew Bailey will feel more confident about cutting. It's a measured line, but it captures the shift in tone. While interest rate expectations soften, the stock market is telling its own story, and it's almost the opposite of what domestic sentiment suggests. UK investors have pulled 26 billion from domestic equities so far this year, the fastest pace on record actually. Yet, the FTSE 100 is up more than 16% on the year, beating the S&P 500 and key European benchmarks. The gap between how domestic investors feel and how overseas investors view the UK assets has rarely looked this wide. Most of the selling stems from caution ahead of the likely tax-rising budget. UK funds saw 3.4 billion in outflows in October alone as investors shifted to cash. Months of speculation around what Reeves might change has certainly amplified anxiety. As one analyst put it, when sentiment turns gloomy, people take a bit of money out. Foreign buyers have moved the other way, adding 15 billion of UK exposure. It's less about enthusiasm for the UK, but more about needing diversification from AI-driven momentum in the US, with the FTSE 100 trading at 17.4 times earning versus 27.3 times earnings in the S&P 500. The UK looks relatively cheap and defensive. It's also worth noting the FTSE 100's disconnect from the domestic economy. More than 3/4 of its revenues come from overseas. Sectors like banking, mining, and defence have rallied, while the more domestically focused FTSE 250 is up only 3.8%. There's a longer-term issue in play here too. UK stocks now account for just 3.2% of the MSCI All-World Index, compared to 7% a decade ago. Pension funds have also started to scale back their exposure to domestic equities, and global passive inflows tend to bypass London. This structural drift remains one of the government's biggest challenges. Sharon Bell at Goldman Sachs explained that UK investors aren't shifting into foreign equities, they're reducing exposure altogether. If allocations rise again, she argues a good part of that flow could come back to the UK. Let's move to a section that brings three stories together, shaping behaviour on the ground. First, consumer confidence has dropped again, which lines up with the previous story. The score for expectations over the next 3 months fell to -44, down from -35 in October. After weeks of speculation around the budget, households appear to be tightening up ahead of Christmas. Amid that caution is one stabilising development. FSCS deposit protection will rise from £85,000 to £125,000 in December. It's the biggest increase since 2017 and designed simply to keep pace with inflation and support trust in the banking system. The temporary higher balance limit will also rise to 1.4 million for 6 months, giving people more reassurance in situations like property sales. Regulators have been clear that the move is about stability rather than stimulus. Property, on the other hand, looks anything but stable at the moment. Landlords appear to be selling up at the highest numbers since 2010. In September, 18% of all properties for sale had previously been available to rent. Concerns about a possible rise in capital gains tax have pushed many to act sooner rather than later, following years of tax changes that reduce profitability. Those who remain in the sector are charging record rents, averaging £1,344 a month outside of London, and in London, nearly £3,000. So, moving on to our next story. Across the Atlantic, the US is dealing with a different set of signals, but the theme is pretty similar: mixed data and rising uncertainty. The US added 120,000 jobs in September, well above the 50,000 forecast. But unemployment rose to 4.4%, the highest in 4 years. On the surface, the numbers point in different directions, and that's what's going to make the next Fed decision more complicated. This report also arrives after a record government shutdown that's delayed data collection, meaning some October figures won't be available before the Fed's next meeting in December. Policymakers will be missing information they usually rely on. There are signs that the labour market is weaker than the headline suggests. Downward revisions cut 33,000 jobs from previous months, and hiring between May and August totals just 74,000. Layoff warnings have also risen, with more than 40,000 notices issued across 21 states in October, one of the highest levels since 2006. Those trends support the case for another rate cut. Hawkish voices can point to a stronger than expected headline number and argue that easing too quickly could trigger another round of inflation. The Fed has already cut rates twice this year, and with mixed indicators and limited data, December's outcome does remain uncertain. Patrick Locke from JP Morgan summed up the mood. It's not easy to know what to make of this report. With conflicting directional moves across underlying indicators, there's no smoking gun to lock in a December decision. This week lays bare just how many moving parts are shaping the end-of-year outlook. The Bank of England now has the data it's been waiting for, and a Christmas rate cut feels very likely. But the relief may be short-lived if the Chancellor's budget tightens conditions elsewhere. At the same time, the gulf between domestic pessimism and foreign appetite for UK assets highlights an ongoing identity crisis in the UK market, one that won't be solved by sentiment alone. Rising depositor protections offers some resistance, yet the surge in landlord sales and dropping consumer confidence shows how sensitive behaviour has come to policy signals. And over in the US, a conflicted labour market sets the stage for another finely balanced decision from the Fed. So, after being the phrase that's cropped up in almost every briefing for months now, the October budget will finally take centre stage in next week's update, and we'll be taking a closer look at everything it reveals. Thank you very much for listening, and I'll catch you later.